All right. Hello, everybody, and welcome to this edition, this edition of Investment Education Academy. We apologize for coming on initially laughing, but it was a funny thing. We have recently found out that you can actually say, Alexa, play Investing Education Podcast. And with that being said, a number of people are doing it. They're telling Alexa to play Investing Education Podcast. And the first thing they always hear when they listen to the podcast is Leon say, yep. And so, so right now, when he said, yep, in my head, I just saw the people who were going to listen to our podcast, hearing him say it again, and it made us laugh. So we are regular people doing regular things, and it was funny. So welcome to Investing Education Academy's discussion for this Wednesday. It is November the 18th, 2020. This is going to be a good one. We're going to talk about Tesla today. Many of you all know Tesla has been added to the S&P 500. However, many of you all do not know exactly what that means. So we're going to talk about what it means. And while Leon gives you kind of why we chose this topic, I am going to do some housekeeping.
Yeah, so really two reasons chose the topic was because, frankly, two IA members asked us about it. Right, so we were one member, shout out to Malcolm. He asked, "Was it going to be the topic?" And another member, shout out to Ashley. She was curious, "Is this the topic? Is this the topic as well?" So I kind of took it as an omen, like, okay, clearly people are interested in Tesla being added to the S&P 500, so that's why we kind of went with this. So a lot of people's questions are, what does it mean, right? And inside the platform, IA membership, it was back in August where the Tesla 5-for-1 split was happening. And at the time, a lot of people were saying, well, what does that mean? And one of the points Brent and I made is that the split eventually could bring on an inclusion of Tesla into the S&P 500 because Tesla was there. So there's a rule that says a company has to have 4 quarters in a row of profitability to be added to the S&P 500. So Tesla reached that milestone. And then they also split, right? And the split makes the stock more affordable to more people, which then makes it more attractive to the S&P 500. So Brent and I kind of made the judgment that, hey, this is kind of right for Tesla to be added to the S&P 500. It did not happen post-split. And a lot of people thought it was done. It would never happen. But it was announced this week that Tesla is now being added to the S&P 500. So what does that mean? What that means is the S&P 500 is the most tracked stock index on the planet Earth. There's no other index that's tracked more than the S&P 500 around the world. I mean, in Asia, Africa, Europe, there are funds everywhere that track the S&P 500. I counted just a little research I did about 100 ETFs and mutual funds that track the S&P 500 just in the United States, and that's all I found. I'm sure there's more. Then there are hundreds or thousands around the world. So what that means is all these companies that track the S&P 500, once Tesla's included, will then have to buy Tesla. So that's going to put a huge tailwind at Tesla's back for buyers of the stock. Now, does that mean Tesla's going to go shoot to the roof? I have no idea. Does that mean Tesla will drop? I have no idea. But what I do know is that there's a higher probability once Tesla makes the S&P 500 that it will not drop and will continue to go higher than it being outside the S&P 500. Because again, you have all these funds, mutual funds and ETFs that now by their mandate have to buy Tesla because they track the S&P 500 to the letter. So
and also real quick, one part to that you all should know is that for a long time, Elon Musk was not the most prized person for institutional money to track just because of who he is. And now they kind of have no choice. So that is huge for him. And additionally, for those of you all don't know why, originally they weren't included in SP 500 when originally thought because they had some of their money was from loans and from some of their, what was the government? What was it? It was their government.
With the tax credits?
Yes, tax credits. And because of the tax credits, they disallowed that information to be included in their application for S&P 500 status to being included in that. And now, of course, they've had their 4 quarters of profitability, as Leon just said. So for those of you who are wondering, like, why weren't they included from the beginning or when we originally thought, that was the reason.
Well, that's one reason. Another reason was that they hadn't reached 4 quarters in a row of profitability. So to be included in the S&P 500, there's certain rules you have to meet, and that was one. One, they couldn't use those credits as kind of a show of revenue. Two, those went away, and then another one was that they had to reach 4 quarters or essentially a year in a row of profitability, and they reached that. So that's one point. So one point is that all funds that track the S&P 500 now have to buy Tesla. So the question is, does that make Tesla now a buy? And Brent, when you get a chance, you can throw up the first slide.
Yep.
So I wasn't sure about this myself. So my assumption is that because all these funds now have to buy Tesla, it would give Tesla a big boost, right? I didn't know that was just kind of my assumption, and just kind of anecdotal evidence I've seen when companies are added to the S&P 500. You typically see their stocks rise. But then the thing is, as we know, being long-term investors, that 1 minute, that one little bump doesn't really matter. You want to see the long-term effect. So what the first slide is going to show is this slide. Yes, this one. So with this, what we have a slide on the screen shows is that.
So for everybody, real quick, for everybody who's listening to our podcast right now, the chart that we just pulled up is the date of index inclusion. And so it's going to show the median range, what is this, of abnormal returns based on percentage on the y-axis. X-axis is showing us number of days. So just so you know what we're looking at.
Yep, and so the chart starts on the far left on the x-axis. It starts 20 days before inclusion into the S&P 500. Then it goes to 0 when it is included. Then it goes out 60 days. So basically what this is showing is how did the stock act 20 days before it was added to the S&P 500, when it was added to the S&P 500, and what did it do 60 days after being included. So what we see, what the study found, what the study is, it's 103 companies that were added to the S&P 500 from 1999 through 2004. And what this data shows is that the 20 days prior, and for people that can see it, you can see on the far left that 20 going from negative 20 up to 0, the median and the average actually increase, right? So the stock price actually increased, was being bid up as its day of inclusion drew closer. And then once the day of inclusion, the stock just takes off. It jumps about average return about 5%. Now, but the interesting part is once it's included, over the next 60 days, the stock actually returns basically to how it acted prior to inclusion.
And real quick, for everybody looking at this jump, or if you're listening to the podcast thinking, oh, well, we know Tesla's had a jump recently. There's one thing to show data. There's another thing to understand the personality of the market. And we talk about this often. This is our yin and yang balance, right? Is understanding that from the number standpoint, again, nothing fundamentally changed for the company. They didn't all of a sudden have the miracle cure for creating solar energy or have some type of capacity increase in how much they could produce overnight. It simply means they were accepted to the S&P 500. And like most things, like a split, like beating earnings and all these other things, nothing fundamentally happened to the company. So when people think all of a sudden it's supposed to be this engine that continues to just have this drive up and it never stops, that's not accurate. At some point, most companies and most investors, especially those who are more sophisticated, they're looking at the fundamentals of the company. They're not looking for just the excitement. The excitement normally comes for the short-term players who, are sometimes driving the market, or the Robin Hood effect, where people hear this news and again, emotionally, they think this means I'm about to win. Let me go all in. That's not what it means, but that's how the market responds.
Mm-hmm. Yep. So as we see, once its inclusion happened, the stock spiked, right? Went about on average 5%. Then over the next 60 days, the median and the average price basically returns to where it was prior to inclusion. So what this means is, yes, typically when a stock is added to the S&P 500, you do get a bump, right? So for those, short-term traders, maybe day traders, it's maybe something to try out and say, okay, you'll buy Tesla leading up to its inclusion date, see if you get a bump. But once that bump happens, typically that bump fades and it'll return to kind of its trading prior to inclusion. Now, one point I also want to make is that so as Brent said, institutional money, which is hedge funds, mutual funds, ETFs, pensions, now have to buy Tesla, the ones that track the S&P 500. And these are billion-dollar, sometimes trillion-dollar entities, institutions. They're not, they can't even buy all of Tesla, their positions in one day, in 1 month, sometimes not even in 1 year. So what happens is over time, yes, they'll get a bump and then it'll kind of fade. But remember, the big boys haven't stopped buying it. It's going to take them a long time to build their position in Tesla because they have so much money. They don't want to, a company can't drop $1 billion in Tesla in 1 day. If they do, they'll move the market, right? The stock will go through the roof. That's not what they want. So they want to slowly build their position over months, sometimes over years. And that's why in the long term, being included in an index is actually bullish for stock because these big companies have to buy the stock and they do it over time. Because again, they can't drop $1 billion into Tesla overnight. It usually takes months and sometimes years. Okay, so that's the first slide. So if you go to slide 2, Brent. All right, so this slide, it's just basically the inverse of the first one. So this is showing what happens when a stock is removed from the S&P 500. And it's kind of the same thing. Leading up to the day it's removed from an index, the stock typically starts to drop. And then on the day of inclusion, as you can see, for people that can see this, at the day of inclusion on the 0 number on the x-axis, the stock absolutely tanks. And again, that's typically because you have some funds and institutional, typically institutions, a lot of times more retail investors will just dump the stock around that time because they in their mind, they're thinking, okay, well, the institutional guys have to get out. Let me get out now. A lot of people will dump the stock. But what people don't understand is that institutions do their buying and selling over time. They don't just do it at one day or even 1 year sometimes. And then as you see, once it drops on the day of inclusion over the next 60 days, the stock kind of returns to where it was prior to inclusion.
And this goes, oh, go ahead. I'm sorry. This goes to show,
yeah, go ahead.
This goes to show there is a certain amount of emotion that you have to think about when you look at the market. Because as you can see, when it returns back to normal trading after some time has passed, again, nothing with many of these companies has changed. They're still moving forward. Now, I will say this: once a company is listed to the S&P 500, because they are now receiving institutional money, they get an influx of dollars that can be used for research and development, which oftentimes leads to having, improved products, improved efficiencies. They have more money to play with, right? But at the same time, the companies that even get considered are normally very strong companies. So it's not a situation where it's a make or break for a company to be listed or not listed. It feels better, and it does create some stability when they know funds have to be invested into their enterprise.
Yeah, that's a good point. Yeah, most companies that are included into the S&P or the NASDAQ or the Dow, or not NASDAQ, the NASDAQ 100 or the Dow Jones, are typically solid, good blue chip companies. And so there's no surprise that that they do get that bump because, again, there's that excitement around the inclusion, but then they kind of return to their typical state. And then again, if it's a quality company, before inclusion, it was most likely ticking up. It'll then return to you then ticking up to where it was. But like I said before, the really bullish thing for stocks being included in index is that institutional companies buy over months and or years. So because they're so big, they can't dump all that money at one time. So you're looking at just a continuous buying of the stock over time, which is really, really bullish stocks that are included into any indexes.
Yeah, and for anybody who's wondering, if you've been following us and we do our picks. We picked Tesla in July 10th of 2020. And if you have been with us, the original pick for Tesla wasn't because of any pending news. We just thought it was a good company. And with that pick, being 6/10/2020, the company's up 118% since we chose it on that date. So with the run up in, the stock price, even with the dip that came around the split, all these things hopefully you all are tracking because we talked about it. And, we're not saying it's like, oh, we talked about it already. we're saying like, this is opportunity really for you all to kind of get these insights way before this information hits. This is also a testament to, the Invest in Education Academy motto, if you will, with the buy and hold strategy. With the buy and hold strategy, both of the charts that we just showed you would do one thing, or it could show you a few actually really important factors. But one of the biggest ones that I would say in looking at it is what happens if you hold this stock over time. And time is one of the big things, especially for Invest in Education Academy we talked to you guys about. Because if you saw this dip, you might emotionally just want to jump on board because it's a dip. Nobody wants to be on a crashing plane, right? But if maybe you just have to lower your altitude in order to take back off, here you are, just with a little bit of time, patience, and the understanding that you can't just bail every time a company has a hiccup in the road. The same way, when we bought Tesla or made the pick for it, we didn't all of a sudden jump off when Tesla has gone through some very bumpy times. If anyone knows, it ranges a $200 move on any given day, or $200 or more. And so there are a lot of people who just bailed. They thought, this thing is over. I'm getting off the ship. Stay in the investments. If you have the ability, let time heal it. And we're going to go to the next one because we are trying to make time today.
Yeah. So here the IEA takeaways. So first one is Tesla will join. So here's an important point. Tesla will join the S&P 500 on May 21st. Sorry, on Monday, Monday, December 21st, 2020. So we have like another month before it actually join the S&P 500. So that all that buying that has to happen won't happen till it'll start then. It won't happen really till into the next year because it won't join the S&P till the end of the year. Second point, as I said, kind of pointed to earlier, I found about 100 mutual funds and or ETFs in the U.S. that track the S&P. And third point is these funds manage hundreds of billions of dollars and will not have to buy Tesla. And as I said, these funds don't buy they don't do like us. They don't buy in one day and then move on. It takes them days, months, and years to build a position in a company. Again, because they're managing billions and sometimes trillions of dollars. So it's a good win that Tesla's back in the long term. And finally, any initial bump Tesla gets after being included in the S&P 500, you can probably look for that to fade after a while, because as we just showed, on average, stocks will jump about 5% once they're included. But then over the next 2 months, that you'll see that bump kind of fade, and not fade dramatically, not like a crash, but just kind of return to its normal pattern, and then continue higher into the future.
All right, and we owe you all 2 picks today, so we will jump right into that. For me today, I chose a company. It's called, pull it up. Give me 1 second. Berry Global Group. Berry Global Group, chose them for a really easy reason. They actually deal with packing material. So they have packing material over the engineered material, non-woven specialty materials, consumer packing, with customized solutions. They operate through the following segments. Basically, consumer packaging internationally. And the company right now, the ticker symbol is BERY, and it's trading at $53.48 per share. Again, the ticker symbol is BERY. It's trading at $53.48. That's the high level, just so we can make sure we get everything to you all. Leon, what is your pick?
All right, so my pick is something I typically don't do, but I'm breaking my own guidelines. It's not a rule; it's a guideline. So I picked DraftKings.
Really?
Yeah, ticker symbol DKNG.
Yeah.
DKNG.
Oh, we know them.
Say what?
Oh yeah, I'm curious to see why you picked that.
So DKNG, today they closed at $47.68. They were up 2.3%. So for you that don't know, DraftKings is it's an online gambling company, and they're huge. Well, they're huge in that space, and that they took kind of a hit when all the sports went away because of COVID, but now that they're back, it's really kind of taken off again. So I picked it. So the reason I goes against my rules is, my rule is typically I don't buy or pick a stock that hasn't been public for at least 2 years. And DraftKings only came public in April of this year, so it's only public for 7 years. But the reason I picked them is because they're like three things that humanity will always do, right? Gambling, sex, and alcohol. Yep. Right? Those three will always be coveted by man. It's just our human nature. And DraftKings, so there's DraftKings and there's FanDuel. FanDuel is not public. FanDuel is privately owned. These are the two heavyweights in the space. And DraftKings is the other one that's public. So I chose them because I'm breaking my rule because it's very early. And I believe people will gamble once they're allowed to in their state. It's been shown that once gambling is approved within a state, DraftKings sees a big uptick in that particular state by the user base. So to run through their numbers, in the third quarter of this year, they just reported their earnings. They grew their sales 98% relative to the third quarter last year. So they doubled their sales in the third quarter relative to 2019's third quarter. For sales, for revenue for all of 2019 relative to 2020, they grew sales by 42%. Their monthly unique paying customers surpassed 1 million. There's the thing that really caught my eye was, and this is in COVID. Like nobody's giving guidance right now on COVID. Nobody can see to the future because nobody knows what's coming. They raised their revenue guidance for the rest of this year to 540 million, between 540 million to 560 million from 500 million to 540 million. So they've raised the revenue guidance going out for the rest of this year, which is huge, which means they see demand picking up and staying steady. Currently, there are 18 states in the United States, including DC, that have legalized gambling, and 4 states just recently passed bills that are going to legalize gambling in their states.
All right. So for everyone, just to recap, Leon chose DraftKings, and the ticker symbol is DKNG. If you're looking for it again, it is DraftKings. The ticker symbol is DKNG. My pick for today is Berry Global Group. The ticker symbol is BERY. Now, just kind of recap, if anyone has been with us and you all invested in Tesla back on June the 10th, 2020, you are seeing an investment in your portfolio that is up 118%. Congratulations. Let's see that happen in the savings account. It's really, we joke about it, but it's really comes back to that point. Please look at where you're keeping your money, especially the money that you don't immediately need, because more than likely you could be doing more with it. With that being said, we thank all of you all for being with us, and we will see you all next Wednesday. And for those who are interested in joining Investing Education Academy, you can go to www.iea members.com. Again, it's www.ieamembers.com. The platform is growing. We're now helping other people start their platforms. So, we look forward to seeing you there. And next week, we'll tell you about some of the deals Leon and I were able to do through IEA this week, actually, that it's been going on for a little while through the Panthers. But you definitely want to, come back next Wednesday. We're going to tell you a little bit about that deal. It might shock you. Have a great day.